Welcome, everybody, to our November Landowner Insights webinar. Today, we are going to talk about the production economics across different production systems and regions in the US. We really want to look at this issue of farming net income. What's the reality? There's no shortage of difficult press out there. We're seeing a lot of conversation in the political arena around support for farmers. And we've got a really exciting group with us today to help kind of dive into a number of different production systems, boots on the ground, guys that are living it every day. Brian O'Neill will talk to us a little bit about California. Adam Woiblet will talk to us about some commodity and fresh market production up in the Pacific Northwest. Mike Grubbs will get into the tree fruit side. And then Kyle Walker's going to give us some insights on what's happening in our core commodities across the Corn Belt and Northern Plains. And we'll also take a trip down to the Delta for George Baird to give us a little bit of background on what he's seeing there. So before we get started in the conversation, there's just a couple of things I want to talk through quick. So the public discussion has been pretty dire, really. If you can get out and Google and see the various articles around what's happening with farmer economics and this pressure on profitability all over the place. Here's just a couple of examples. And we call out Arkansas, the Delta here. That's been a place where we're hearing particular distress is sort of building. Can't wait to get into that conversation a little bit. And I'll be pretty interested with Adam and Mike to dive into this article that we found. Washington Ag dropped from 28th in the national net farm income in 2023 to 43rd in 2024. That is a real problem. That lines up with a couple of areas where in our business we have seen a little bit of distress. The primary theme that's driving this discussion is when we're focused on the large scale commodities, which represent the vast majority of acres of production in the US. Prices have fallen really sharply coming off of our latest inflationary period, but the cost of production have held and in some cases have hit records, soybeans, wheat, and cotton in particular, but at a minimum stayed up at the upper echelon of what we've seen before. So that's creating that kind of net income tension that's really behind a lot of the discussion. And another article that came out in the summer, which a lot of folks may have seen, was a Wall Street Journal article. This is a graphic that was pulled out, that put together with some data from the University of Arkansas that's looking at losses all the way back to 2013 and even more deviating losses as we get into 2025. I know there was a few of our clients that caught this article, grabbed their attention. We've had to have some conversations and thinking through what this really means and thinking about farmland investing. And we'll be super interested in kind of hearing a little bit more from George on how he's seeing this and what's the reality in his world with his boots on the ground. Now, there's a flip side of that, right? So if we go back to the latest ERS forecast, which would have been early September, we're looking at the second highest net income year from a forecasted standpoint on record. So that creates a little bit of attention. Now we've got to recognize that a big chunk of that is high profitability in the animal ag sector, particularly on the cattle side. So that's driving that number. And we've also got something north of 30 billion in ad hoc subsidies that have been a part of creating that higher net income number. So while the number's big, there's a couple of things lifting that up, but that creates a little bit of attention. That doesn't paint the picture of the popular press dire straits at the same time. When we look at what's happening on the balance sheet, assets are moving up slightly in the forecast, so is debt. Both are just sort of incremental gains. The net debt to assets ratio is anticipated to move up slightly, but still under 13.5%. So very low debt coverage within these forecasts as well, which still represents a reasonably solid and stable sector at the same time. So I want to start by getting into the boring sort of Midwest corn and soybeans. Let's talk the Corn Belt and the Northern Plains with Kyle just a little bit. Hey Kyle, what's the farmer sentiment really look like just in your conversations as guys are getting through the fall here?
Yeah, so first, I thought I maybe just quickly introduce myself, Dave. Thanks
Yeah,
for.
absolutely. Sorry about that.
So I'm Kyle Walker, and I'm the Director of Land Management here at People's Company. I've been managing farms for about 20 years, been with People's Company about 13 years, and I'm based out of central Iowa. As far as my, production economics and what I see, I have about 18 custom farms in central Iowa and southern Iowa, which is typically not the best part of Iowa to custom farm, but that's where I've kind of cut my teeth and about five different counties. And so as far as tenant sentiment and what I'm hearing, Dave, I think the guys are a little bit more optimistic than they were 3 or 4 months ago, when lease termination time was coming out here in central Iowa, that September time frame. We actually got a few terminations from tenants, which we typically don't get. And guys were saying, hey, we're not able to pay the rent numbers we are, or I'd like to renegotiate. But now as we kind of come back around, those same guys are saying, "Hey, I'd probably go ahead and take that lease for what I was paying last year." And that's because beans have gone up a buck over last month, and corn's up as well. And so a little bit different dynamic. The guys I think are feeling a little bit better. Yields have come in really well. Not as good as I thought yields would be. Back in July, I did a podcast for strategic farm marketing, Dave Chatterton's group out of Champaign, Illinois. And I was almost giddy. I was smiling. I was saying, hey, there's nothing that can stop this corn crop, and it's going to be the best crop we ever had. And then Southern Rust came in and completely changed everything, and I never seen anything like it. And so corn yields, I thought I would average over 225, up to even 250, 260 across all my custom farms. That probably didn't happen. I did have some 250, 245 type numbers on some farms, but most of the stuff came in that 220 type range, and I thought it'd be a little bit higher than that. So.
So the 186 most recent WASD numbers that came out, I still don't believe that. I still think that's high based on what I'm seeing, our conversations. How are you feeling about that? Do you still think that's an overstatement of what it was actually out there?
I do, and I don't, I've been thinking that a lot lately, and I don't know where it's going to come from, and so I don't think Iowa's going to be nearly as good as what they thought. I think Illinois surprised some people, but Illinois is not, you know, over what they typically do by any stretch of the imagination. The Eastern Corn Belt as well. I know Nebraska had some record yields. Parts of Minnesota, Southwest Minnesota did really well, but I just don't think that those yield numbers are going to raise that overall number to the point where we're going to get 186 now. Do I think we're going to have record yields as far as volume? And I do. I think we'll top that 16.5 billion, or be close to that 16.5 billion number, but I don't think we'll average 186 across the board.
So, thinking about your custom farms as a place where you get some very specific information, you understand the cash flow, you understand the net income. Give us a little bit of a picture in a very general sense on where 2025 lands between those same farms in the previous few years. And then also just thinking about it in the context of if those farms were just leased out to a tenant, right? That gives us a little bit of a tension point around what was actually happening with cash flows.
Do you want me to focus on corn or beans, or corn would probably be easier for most people,
Yeah,
or?
corn would be great. Yeah.
Yeah. Yeah, so 24, I had phenomenal yields. I think I had the best yields I've ever had across a lot of those farms. And then from 24 to 25, my economics as far as my input numbers went up about 10 to 15%, primarily based on fertilizer. And so, going into the 2025 crop, seed went up as well last year. We are a little bit higher. And so typically it costs me, as far as when I'm custom farming, and this does not include rent or anything on it. It's just strictly, what it would cost on the expense side for, fuel, machinery, paying somebody to plant and harvest, and then all the actual direct inputs for the crop. But I'm typically in that 550 to 575 range is kind of what I have penciled in for this year. And I think for next year, just based off of the increase in nitrogen and phosphorus specifically, I think we're going to be pushing that 575 to 600 range. And so, I think costs are definitely up to put in a corn crop. It's not as bad for beans because you don't, of course, have nitrogen involved, but I think they will be up a little bit. I haven't seen much of an increase on chemicals. Some of the other things that you would think would go up as well, as far as like your direct production with fuel and labor and whatnot. I haven't seen a huge hit on that. And I typically just pay, for each, if I pay somebody to plant, I pay somebody to harvest, and so much per bushel to get it to town. But the dynamics are essentially fertilizer and seed would be the biggest drivers.
So if we put that all together, I think what you're saying is 24 was pretty solid in terms of the return to landowners that were custom farming. 25 is going to be lower. Would you say that your average custom farm in 25, the landowner's making more or less than they would have if they just leased it out?
Yeah, so that's a great question. Typically, it kind of depends on how well structured the lease is, right? Some guys are a lot more willing to overpay for a lease in the first year or two, and then they get a little grumpy if the lease rate is really high. But typically, what I found is that the custom farming and the rent numbers that we see are very competitive. But if you really watch those expense side and the inputs and what you're paying people, and you do everything right, the upside for the custom farming is much higher. And so when I say we have a strict cash rent lease, we typically have a flex on that. But that flex provision may only be like a 30% above a certain portion where you get 100%, of that if you're custom farming. So the upside is much higher. The risk side is also higher because, you're only guaranteed a certain profit by the federal crop insurance. But a lot of my custom clients, when they start custom farming, they rarely do they go back to cash renting.
So, just as an indicator of that kind of aggregate economics, I think what I'm hearing is that, farmers at the rent level relative to what you're seeing very specifically from the custom farming should be okay coming out of 25. And if they're managing their cost of production reasonably tightly around labor and equipment, et cetera, you're not seeing this massive loss environment that you kind of feel coming out there in some of the popular press.
100% agree. And then, I call them Trump dollars are coming down the pipe, right? We keep hearing about, what's coming or what's not coming. But I do believe we're going to have significant, if you want to call them subsidies or, Trump bucks or whatever you want to call them, but they are coming. And we don't know exactly what those are going to look like yet. But I do think that that's something that needs to be factored into the equation as well, because we'll see a lot of those dollars here in Central Iowa.
You bet. Speaking of ad hoc subsidies, I suppose we've got to move to the south now, right? You guys are pretty effective at making sure there's a fair bit that flows in your direction. George, do you want to give a quick introduction on who you are and what you're up to?
Yeah, George Baird, Senior Land Manager across the Mid-South and Delta area, specifically focused on Eastern Arkansas, Mississippi Delta, with a little bit in Tennessee, focused on primarily managing for absentee landowners, investor groups, and been doing this for 32 years. Just finished the 32nd crop, so seen a little bit of it all in that time frame.
Yeah, so the with your vast network, I gotta be honest, right? The what we hear, like the Delta region is maybe has the biggest fire burning across the whole country, and I've heard large landowners say that they think 20% of farmers are going to be done after this year. And, I referenced that Wall Street Journal article showing consistent losses since 2013, I believe it was. Give me a feel. What are you seeing in a broad strokes kind of perspective?
Yeah, that chart is really interesting. Based on that level right there, we should be at $2,500 acre land and virtually nobody in production down here in the Mid-South. But that's just simply not the case. Matter of fact, we went on up until this year, we went on a pretty good run for the last 4 or 5 years, especially from a landowner investor standpoint, print some of the biggest returns we've ever printed, on a quarter share basis. And meanwhile, those production costs kept easing up, moving higher, but guys are still making money. Now, if you're not taking care of your marketing and taking care of your overhead and cutting out the duck leases and all the extra, yeah, maybe you were losing money, but it's not nearly to the level they were saying it was. And things are really, while they've backed off a little bit this year, are the cost factors or the returns have been probably more impacted by the weather and then just maybe some marketing issues that we've run into, especially with a crop like rice, where if you did not have yourself positioned right, yeah, you got caught, on the wrong side of the curve. And so I think some of these things are catching back up. 20% farmers going out, I think 50% of that 20% are really guys that are retiring or just pulling back acres. I was telling one of my landowners just a few days ago, like I've averaged one or two lease changes a year for 30 years, and I'm working on 10 right now. And of those 10 lease changes, six or seven of those are guys just restructuring. They're letting go of their marginal acres. They're letting go of acres that are 30 miles away from their headquarters and not, within 10, because your better operators are getting calls every other day to pick up good stuff. So a lot of optimism. And of those 10 leases, six of those I've actually structured a better lease going into this coming year than I had. And some of it's based on these government subsidies that they keep adjusting, the optimism around the SDRP, things like that. And I think some of the headlines kind of get self-induced, right? When 500 farmers show up in Northeast Arkansas at a hearing to talk about how bad it is, well, everybody kind of wants to have that pile-on effect and be part of it so we can try to get more money. And then when the SDRP comes out and they said you're only going to get $25 an acre, they get upset. Well, Senator Bozeman and the Rice Council and everybody went to bat for us on the PLC ARC, and so we have to give a little bit coming forth. But when you take it all into consideration, looking at the numbers I pulled recently, and happy to share those if you would like me to, from a landowner standpoint, it looks pretty good. Crop
Yeah,
wise, this past year, the yields were in the weather really probably hurt us more than input cost and prices.
go ahead and pull that up, George, and I'm going to ask you a question while you're doing that. So, um, that's pretty good data, right? From boots on the ground, touching a lot of acres throughout the Delta region. You very clearly are seeing more lease changes than what you have on average, and it's substantial,
Yes.
right? But you're saying that a significant, maybe half, maybe even a little bit more, if I heard you right, of those changes are associated with guys that are just sort of pushing back from the table, and that might be pseudo retirement, that might be just sort of cleaning up their broader approach to their farming operation, less so than the banker saying you're done
Yeah.
type of dynamic. And then, even more importantly, as we think about it for landowners, you're saying that filling those leases on that ground going forward has not been a problem, and you're actually driving to potentially better outcomes.
Yeah. Especially if you had, say, I'm working on one now has three tracks. Two tracks are really high quality. The third track is a little bit marginal. Well, we've got to increase our income 25% on a cash rent basis on those two tracks, where we only gave up about $10 an acre on the third track. So net to the client's going to be better because now instead of having one producer kind of getting us across the average, we're able to segregate those farms out. So that's been really good and very positive. Um, as far as that standpoint. And a lot of you mentioned guys cutting back. This is where I was wanting to go acreage wise. One of a big producer I just started working with this year was farming 12,000 acres. Well, he's maxing out because of payment entities, for government payments at about 5,500 acres. He said, so I lost $1 million, but I'm laying over 1.2 on the table with these high projected subsidy payments. What's the point? I'm 68. I'm going to back down to 5,000 of my best acres, lease out some of my land to other producers, and I'm going to take more time to enjoy with the family and everybody else because just you can simply cannot create that many Christmas trees, as you will, if people have heard the term Mississippi Christmas tree. At some point, you got to cut off your tree farming. But so that's really impacted a lot of producers as well as looking at it. But then other guys that are sitting there that have done a good job marketing or taking care of their overhead costs, they're coming in and no problem picking those up. And I was a little worried about it going into it a month ago. I'll be honest. I was pretty uncertain of where we're going to be. And I was saying for the first time ever, we might see some of this. We always talk about 0% vacancy in farmland. that could change this year, especially on marginal acres that have any kind of production cost or production problems with them. Because this year we did see, we had 30 inches of rain in the northern half of Arkansas, 30 inches of rain in April and May alone this year. And so we still ended up with pretty good crops, but they were down 25%, especially on something like cotton versus last year. And so that's impacting the bottom line too. But when it's all said and done, landowners and investors have a real opportunity to maybe pick up some good land and continue to print some decent returns. As you can see here, while might not be ideal, we're not off that far from where we were a few years ago on something like rice, where we were seeing, returns of 325 to 350. Well, if you can take the payments, and even if you can't, a producer's going to factor these payments in there as far as what they can, be willing to pay on land, so you can capitalize on some of that.
Perfect. So, just sort of wrapping up the delta a little bit. I mean, I think that's pretty informative in the context of guys are stepping back, backfilling is not been a problem. You're getting good outcomes. And then your work here, kind of thinking about your region as a 25% share, you're seeing, a little bit of a pullback on from some of the peak inflationary period returns to land. But what you're seeing here is pretty strong. Give us a little context on this kind of forecast, generalized forecast into 2026 versus the last 5 years.
Yeah, I think it's going to hold fairly steady with the numbers you're seeing here. And actually, this stress in the market could give us opportunity, as I mentioned, to renegotiate some leases. So I just use 25% because that's the most common lease structure here. But I'm working on two specifically over the last few days where, okay, a guy doesn't want to grow rice because the margins aren't there for him. If you see before government payments, net loss of $29 an acre, and the only way he's making money is with government returns. Well, so maybe he wants to take that solid rice farm, go beans or corn or some other crop. Now that opens up the conversation to let's structure our government payments a little bit different, so we could actually, maybe even increase these numbers a little bit more based on, really sitting down and looking at our farms. And to me, that's one of the takeaways this year, especially is, and generally our lease structures have been pretty common across the whole Delta, with a few tweaks here and there based on some microclimates or micro regions within the Delta. But now each and every farm stands on its own. It's its own personality. It's its own, monster, and we have to look at it and really dive into understanding all of it and seeing where we can take advantage. Because at the end of the day, we want to partner with the farmer to make sure the landowner gets the best returns. And we can't do that just run them out of business. But there's some opportunities to restructure, what are traditionally been or what have been traditional leases, and let's look at it. And let's have honest, open conversation, with producers about it and landowners. I've had more opportunity to talk to my landowners, investors, have real meaningful, deep conversations in the last 5 weeks as I have the last 5 years. When things get tight, it really gives us opportunity to show our value and really step in and be an advocate for the landowner investor as to what we can do and make sure we protect their investments.
Very helpful. I'd like to move up to the P&W on the commodity and kind of fresh market row crop side with Adam. Adam, do you want to give a quick intro on, what you're up to up there?
Yeah, absolutely. So I'm Adam Woiblet, president of Agribusiness Trading Group. Agribusiness Trading Group joined the People's Organization back in 2018 now as a partnership company, and we cover the Pacific Northwest states and Montana out of the office that's in Eastern Washington up here. So yeah, kind of to keep the conversation to more or less the main commoditized crops up here. We'll kind of go over wheat, potatoes, hay, and onions, sort of broad strokes, and then yeah, happy to dig in on any of that stuff, Dave, if you'd like. So just generally speaking, the wheat farmers up here are still more or less at break even or making just very small profits on a per bushel basis. So one of the things that they've really been concentrating on is just trying to increase yields as much as possible through both practices and equipment and technology, that type of thing, so that they can, as an overall organization, try to make some profit and hang in there, hopefully, so the prices turn around a little bit here. But overall, 2026 is expected to have another very good crop as far as overall yield goes. We have had some pretty decent moisture throughout the Pacific Northwest this fall. So for the dryland folks, they are having a pretty decent moisture profile built up for the winter wheat. So that's looking decent. As to potatoes, 2025 did have a reduction in planted acres overall. However, the yields were up, generally speaking. So overall, the markets didn't really change that much there. Russet prices continue to be quite low. So they're, again, very, very close to break even or just slightly profitable on a per acre basis there. And again, yield driven to keep the overall profits up for the organization. So coming up actually in December is when they start to do all of their negotiations for contracts. And that's primarily in the Columbia Basin, some in Idaho as well. So that'll kind of start determining outlook and contracts and whatnot for the 2026 crop there in the potato world. So on to hay. Demand is still pretty low for overall hay, both Timothy and alfalfa, primarily just due to reduced herds up here in both the dairy and the beef cattle industries. The hay folks are still hurting just a little bit there. I know that some of the banks are kind of tightening up their credit and whatnot there. So we'll see how that goes. We are expected to have kind of a colder winter than normal due to some La Nina forecasts and that. So that could actually bring up demand a little bit for the hay, but we do still have quite a bit of hay in storage from some past crops. So it may not be an immediate increase in hay prices there. And then on to onions, just overall, there are some more folks starting to use onions as increased rotation crops just because there's not a lot of other alternatives out there. So what that has done is kind of created an excess supply by and large in that market, causing the overproduction, that type of thing. And there are a few specialty onions, like some niche sweet onion markets, that type of thing. Those guys are still doing pretty good. But overall, just generally speaking, yellow onions by and large are operating right about at cost, or in some cases, maybe just losing a little bit of money on a per acre basis there. So as far as, looking forward to 2026, it's going to be interesting to see kind of what happens in the export markets across almost all of those sectors that we just talked about there. I think that's going to have a pretty big impact. And then also, hopefully, oil prices come down just a little bit. And of course, that's going to affect overall input costs. And that's been the biggest squeeze on these guys is really prices. Commodity prices continue to be low. Current input prices continue to increase, and that's what's really creating the squeeze here.
So a couple of things I want to dig in with you quick, Adam. We've had on some assets, particularly some wheat assets that we work together on in Eastern Washington and Eastern Oregon. Some distress has popped up that's actually created some challenges. Hearing a little bit of a chatter from some folks in the lending community out there that working capital is going to get tightened up a little bit more. That seems to be a major trigger for creating some of that distress. You guys are on a cycle out there where the lenders like to get as much information as possible, moving even into late winter or early spring before working capital lines are issued, right? Get that latest financial picture. What do you think? What are you hearing? Like, are we going to have some operators that late winter, early spring are going to be calling up their landlords and saying, "Hey, I didn't get my money"?
Yeah, unfortunately, I have heard that actually happen here in a few instances already. Talking to some of the lending folks, they are starting to put some folks on notice here, some of the producers on notice that, hey, things need to change a little bit, or 2026 may be the last year that we're extending credit to you here. So overall, producers, what they're really trying to do is just get as lean as they possibly can. I've even heard of a few of them, doing sale leasebacks to clean up that balance sheet a little bit and put them in a little bit stronger cash position. They're just overall, folks are trying to be as lean as they possibly can to keep that little bit of profit going that they have. So.
How pervasive do you think it is, right? Are we talking about these conversations happening with 10%, 20%, 50% of the folks in a serious way out there? And I'm making you speculate on something that's probably not fair, but I'm going to anyway.
Yeah, the dryland wheat farmers that are in the areas that are a little bit more fringe and are more subject to Mother Nature and can't quite increase their yields, kind of to meet some of those needs we've been talking about as far as the small profit on just higher yields or keeping them in business. Those guys are probably some of the hardest to impact folks. Overall, though, from the I guess bright spot that we have here is we have great irrigation water in many of the areas, and weather is very conducive to good yields out here. So I think it's just a new way of doing business for a lot of these guys. They're just really having to watch their inputs and make sure that they're not putting too many inputs on for what the ground will support, and just be really focused on controlling costs.
The other thing I wanted to hit with you really quick, when we start thinking about these fresh market crops, the spuds, the onions in particular, that has a different character than what we've talked about so far, right? Kyle's working on corn and soybeans primarily, which is just a marginal game overall. George's crops down in the Delta, the wheat side of it. These are incredibly high input, incredibly expensive and high revenue crops where the swings in pricing, the swings in costs and production, you move from what you'd think of as shallow losses potentially to that thousands of dollars. And we're kind of moving in that theme as we head into the permanent crops here shortly as well. But, what are you seeing in terms of potential exposure? And obviously you're going to get some feedback on contracts here over the next couple months that are going to help guys out. But this can swing pretty quickly for those guys in terms of really significant losses.
Yeah, for sure. And one other part of that whole equation too is a lot of the larger producers are vertically integrated. So they may have some of the downstream from farm assets there too that are trying to control costs, especially with some of our new labor laws and things like that in the Pacific Northwest. So yeah, you're absolutely correct. Those guys are hanging out a little bit, not just on the farm, but in other ways, too. And a lot of legislation has happened over the last few years that's not overly business friendly in some of those sectors as well. So that's affecting them.
Yeah, so maybe a summary there is a lot of break even, a lot of maybe some shallow loss, and uncertainty into 2026, particularly on the fresh market side. We've got to see where contracts are coming in order to try and get this figured out.
Agreed.
So I'm going to move to Mike, and we're going to talk P&W tree fruit just a little bit. I wanted to pop this slide up. This is actually a little bit of an analysis that we've done with some help from the TIA Research Center, Farmland Research Center at Illinois, looking at the NACREIF returns. So National Council of Real Estate Investment Fiduciaries. It's a dozen plus institutional investors, and they break this out by their annual cropland portfolio and their permanent cropland portfolio, which is going to be diverse. But I think the lion's share, and Brian and Mike, you guys see this directly, is going to be in the tree fruit and the P&W and the tree nuts in the Central Valley of California, with some wine grapes thrown in there and a few other things sprinkled in. Bottom line is 23 and 24 were highly negative in terms of returns. And, there's certainly some value drivers there on the core assets. But there was a lot of just operational losses that popped through. And Mike, I guess the first thing, if you want to give your introduction quick, and then give us a little background on the oversupply issue in your region.
Yeah, good. Thank you, Dave. Yeah, Mike Grubbs. I've spent the last probably 7, 8 years working with institutional investors that came into the tree fruit industry here in the PNW. The last 4 years with Columbia Farm Services as Director of Business Development, which basically is working with uh, uh, these institutional investors. The first couple of years, we're looking for assets and acquisitions. We'd previously made money in the tree fruit industry, and that's why we planted these modern factory orchards and got to know and working with people like Adam and the People's Group, because there was very few assets for sale. And so that's where I started out. And like I said, it's been a great industry out here. High inputs, a great place to put capital to work with our factory orchards. I think you're aware, Dave, of um, 60, 70, $80,000 an acre fully invested in these modern fruit factory orchards. And then our operating costs are also high, compared to what the other folks are talking about. So our operating cost per acre growing, including harvesting, can run from a low of 10 to probably 16, $18,000 an acre. So we use a lot of capital. We need a lot of money to operate and pay our bills. And then obviously we've been in this oversupply and net losses here in recent years.
So let's talk about the oversupply and the losses just a little bit. So we were chatting a little prior, and it's still getting dialed in. There's still a little bit of data coming in, but 142 million boxes produced in Washington. Is that kind of in the range of where this is going to land at?
Yeah, Washington is the largest producer of apples in the United States. I think we're close to 80% of the total. And earlier estimates, people, as I shared with you earlier, Dave, was was thinking it was going to be a smaller crop this year, but right now it's still looking like 142 million. I think our record crop a few years ago was 146. But we've had the other issue we've had is we can't sell all of our crop in one year. So when we start I use August estimate because that's a normal year we would be out of old crop. We've been carrying over about 10 million boxes of old crop that go into the fall. So we're starting in the hole. But again, it looks like with the November 1st estimate that came in a couple weeks ago was 137, and we continued to harvest some late varieties for a couple weeks. So the gut feeling is we'll have another record crop.
So just context, right? And this is a moving target when we start talking about markets, we start talking about tariffs and what's happening on the export side. But our understanding is that the right size for production would be in the 115 to 120 million box range relative to what the market's looking for right now. Is that about correct?
Yeah, some of the industry experts and looking at the supply demand and the export curve and everything is it's probably domestically 100 million boxes and 20 million export. Our export markets, as you guys know, and fresh produce, if we had large crops, we were always in the past able to export our oversupply somewhere, or the domestic retailers would absorb. We might not have made any money, but they would help us out. And nowadays, the retailers have changed. They won't take care of our oversupply. They have theirs built in, what they're going to sell through their stores and networks. And then, of course, the export with all the global issues, tariffs whatsoever. Our best markets are close to home, are basically the Canada and Mexico, and we just don't have much bandwidth anywhere else in those other countries. India was a big place for Red Delicious a few years ago, and we shipped a lot of fruit, but that's all changed, post-pandemic in 2017.
So if you were going to snap your fingers and right size that production to the market as it exists now, how many acres of apple orchards need to come out?
Well, it's acres and estimated volume, but but we haven't had a NASS tree survey since 2017, and so part of that was the pandemic, and part of it was USDA. I feel we need one, but my guess is that it's a minimum of probably 30,000 acres. But the big thing we're oversupplied in is low quality. In our case, is low colored old strain apple varieties, because we still get paid on color and premium things like that. So we've planted all these new orchards that are tremendously productive with high quality fruit, and that's primarily what our group works with. Is we've had greenfield and reproduction, replanting of these orchards. Our investors came with CapEx money to do that right. So we have a big percentage of our client base is that production's increasing the last 3 or 4 years. And then we have a few clients that bought the traditional orchards where we have a mixture of good and bad and grafting and removal. So anyway, production of these old varieties. The other one in our industry, and if anybody goes in a grocery store, we went from primarily red delicious and golden delicious 25, 30 years ago to now we have probably 20 some different varieties that might be in a store. So the retailers are changing that for us. They will not shelf space that many varieties. So we have old, poor coloring varieties, and then we also have these club varieties that the retailers won't support now. So between those two things, we've got plenty of room to remove orchards completely and then change varieties of these others, what we call grafting, changing the tops.
Yeah, so the varietal obsolescence issue creates quite a sort of bifurcation in terms of the economics. So, the overall news is tough, right? Absolutely. You see it in basically every context. But if we're going to get into the varieties that the consumers liking, the retailers are liking, the productivity's high, right? They're fairly recently established with all the right technology. What did the economics on that segment of the market look like this year?
Well, most of the varieties, if I understand your question, Dave, is the core varieties and things. Even the best fruit, we're losing probably $6,000 an acre of acre production for the best varieties. And then the other varieties that have the mixture of not as good a quality or odd varieties, we're losing as much as 10,000 acres. So it's staggering losses, and one of the misconceptions, at least in our industry up here, a lot of people, boy, I feel sorry for the small growers. Well, everybody's losing money, I mean, it's just it's more zeros than what. And then, of course, we have the vertically integration, where the packers, get the packing revenue and then grow the fruit. So we have a little bit of, countervailing issues there, but the losses are staggering. That's happened. It's going on 3 years. And like I shared earlier, this 25 crop coming in now with a 10 million box carryover. There's nothing to show that pricing is going to improve much. It's pretty well been flatlined for many years. And then, as Adam mentioned, we're high input and also high labor. And here in Washington State, we've got a political climate that we have mandated minimum wage increases yearly. We technically have a state that's trying to find more money, without getting into the political side. So our costs have been increasing. Our demand has been flat to declining. And so the only thing we can see, and I've been working behind the scenes, is try to educate everybody, is we've got to get this supply demand balanced. And I think even the domestic retail grocery chains are going to help us, because they don't want all these varieties.
Yeah, so kind of closing out this theme, that's incredible, right? When we start to think about multiple years at that level of loss, that's putting financial distress across landowners. The landowner tends to be the farmer a lot more in your system than a lot of other parts of U.S. ag. Um, when we think about and we see orchards that it can be bought below replacement costs, sometimes significantly below replacement costs. And one of the key questions is, okay, I understand that there's an operating loss now, and I understand that the system's in the process of reorganizing itself appropriately to be a going concern in the future. What does that look like, right? I got to imagine 2026 isn't going to necessarily be a ton better, maybe marginally better if we see some acres come out, but this continued overproduction, like what are you guys communicating with the folks you work with around what this runway looks like before this thing is producing positive returns on an operational basis?
I think the biggest thing we've had is trying to share with our customers, our growers, our clients, and their investors is like I said, fortunately we've had pretty good orchards developed with good varieties. It's just we got to stay the course here. So we've been cutting costs. That's been the biggest thing is cutting cost. We're trying to do it. The clients have called us and said, "Hey, there's no more money." I mean, it's we're getting down to one uh, OSU, Oregon State professor. He's retired 20 2007 called it the death spiral. We had a bad period in the tree fruit that you can't just keep cutting cost without affecting quality in our industry and most industries. So there's a point there. And in some cases, we're getting real close. There's people in the industry that just don't have the resources. So I've been calling it under farming the polite way for the last 2 or 3 years. So quality's being affected out in the industry, but with our clients, cutting costs, trying to maximize, where that fruit is, where it's being marketed, where it's being packed and sold, being with the top operators. So that's what we're trying to do. We know in the industry, back to the financial, most everybody, and Adam and I have had this, how long can people keep going? We're surprised there hasn't been more financial turmoil. And quite frankly, I think the banks have done everything they could to rewrite loans and restructure and everything to try to keep people going. And we have had good land values, appraisals and stuff. They've been using appraisals from 4 or 5 years ago, but those are now being reassessed, and some of those are being used both at fair market and liquidation values. So those land values are coming down. So that's going to squeeze balance sheets, and quite honestly, that's what people that's looked at it even in higher levels, the investment bankers and stuff. I think our balance sheets have been really eroded in the last couple of years. Credit will be tightened up. We're surprised it hasn't been already, but we think going into 26, as Adam mentioned, in all sectors here, that banks are going to have to cut some people off. So there could be some, but the banks have been reluctant to take them, to force the issue or take them back, because again, our growing cost to farm these orchards, even minimally, in some cases could be the same value of what that land's worth. So, and that's the same thing in trying to sell an orchard as we try to value. There's a lot of orchards out there that growers or people want to lease or to sell, but we really don't have anybody interested in that in this current market, which is, I haven't seen in my 50 years that bad in all sectors.
That's tough. I think that sounds worse than the Delta, George, even though the news that's out there may be a little bit different. There is a flip side, Brian, when we moved down to California, where it's been pretty dire, and now feels like maybe we've got some things cooking along. Do you want to introduce yourself and what you're up to there in the Central Valley?
Yeah, Brian O'Neill. My company is Huron Orchard Services. We're here in Fresno County, Central Valley. We farm mostly pistachios and then almonds, some olives for olive oil, raisins, and a couple row crops mixed in there too. And yeah, that's primarily what we do. We've been teamed up with the People's Company for 4 or 5 years now, working on a few different projects.
So you guys experience some of that in your management, some of that challenging, like you just can't figure out a way to get to a positive net income here for a couple of years, but it kind of feels like almonds in particular, pistachios also, I guess, have made a little bit of a turn to where aggregate economics feel like operating at a net profit again in 2025. Is that accurate?
Yeah, almonds for sure. We had a stretch of 2 and maybe up to 4 years for some people that were definitely red ink years. It was a tough marketing time for them because we were working through a glut in the almond market. We had some tariffs that we were fighting against in the Asian markets that kind of depressed some of our ability to export over there. We've got made it through those, and actually statewide yields have come down a little bit to match what we can safely market every year. And the 24 crop seems to be like it's going to be the first profitable one in 4 or 5 years for the almond guys. 25 crop looks like it will be even more so profitable, especially since our statewide yield projection was not doesn't seem like it would be met. We're not going to know that for sure until January when all the crop is finished being processed. But right now it looks like we're at least 5%, maybe up to 10% lower than what the subjective estimate was that the USDA came out with.
So you called out a couple of things that are pretty interesting to talk through in your market, right? Like you're still trying to figure out profitability for the 24 crop to a degree. And this is one of those real challenges in your space where primarily the landowner is the farmer, right? Is the
Right.
operator that owns the crop. And you've got cycles 18 months plus before fully realizing revenue, correct?
Sometimes, yeah. Yep.
And so that
So
that creates dynamics that are super interesting just in terms of thinking about land ownership and the cash flows.
totally. And, going back to something that Mike mentioned earlier, right? Under farming is something that we've seen a lot in that almond space. And it really where it falls out is it's something that people haven't done in a long time. So when those crop estimates come out, they're based on trends and data from, how farmers have operated over the past 15 or 20 years, but not many people have under farmed almonds over the past 15 or 20 years like they have in the last 2 or 3. So when we get actual receipts, it's not really matching up with what the estimates are earlier in the years because of that under farming.
Yeah, and so with that under farming, it gets into the dynamic that's super unique to California tree nuts, where the cost of water in a given year can move significantly. And then subsequently, that can change that economic picture in a really unique way. Talk a little bit about maybe some examples on what you see there.
Yeah, well, we can't really talk about California agriculture without talking about water, and I'll talk about the long-term trends first. State Groundwater Management Act is the biggest of that long-term trend. And the past 10 years, we've been looking at kind of the planning phases of how we're going to get into the State Groundwater Management Act. And we're right at that end of the 10-year planning phase, and now we're at the beginning of the implementation phase. And in order to get across the finish line of becoming sustainable in groundwater management, these different basins have implemented different rules, and there's carrots and there's sticks involved in a lot of them. The carrots have been out there for a few years now, and people are recharging where it's appropriate. And now this year and next year, the next few years are where we're really going to start seeing some of the sticks and the costs of production in those areas where they've been overdrafting historically is going to go up a lot. And what's going to happen for some people, they're going to find out in their property tax bills, they're going to get some pretty big extra fees commensurate in the amount above their sustainable amount of pumping. So there's some large almond growing, pistachio growing areas that are going to see an increase in their cost of doing business to farm permanent crops.
So let's play that out, right? So pistachios and almonds in particular are on the right side of the price trend, right? That gets folks excited, that gets capital ready to go. We've certainly talked with some capital partners that are sort of interested and can see that those price curves have historically tended to have some reasonably predictable sort of wavelengths, if you will. The specific size of the waves may ebb and flow just a little bit, but those wavelengths. And so all signs are saying, hey, we're on that upward trend. Capital's motivated. How much can this added cost of water change that cost of production relative to that price cycle and coming out of it with a profit?
Well, I'll give you one example in it's called White area of Madera County. Their sustainable yield plus the amount that they're giving you called a transitional yield is roughly 26 inches per acre of land owned. And if you farm 1 acre of pistachios, you're going to need about 36 inches minimally to grow a mature pistachio orchard. So you're going to pay additional fees, and this is in 2025 on 9 inches worth of irrigation water for every acre that you own. And that fee this year, I think, is around $250 to $300. That will only increase over time by an additional $100 per acre foot. And also your sustainable plus transitional yield is really the transitional yield is what's going to go away over the next few years. It's going to decrease by roughly an inch every year until you're only left over with the sustainable amount that you can pump. Ultimately, it's going to be around 1 acre foot per acre. So if you're in a spot with an almond or pistachio orchard that is marginally economically viable right now, and you're looking at next year and the year after where your water costs are going to go significantly up, your energy costs are going to go significantly up, and your labor costs are going to go significantly up, you need to stop the bleeding now. And we're seeing that in the white areas where people have these orchards that are becoming less and less profitable and have less and less hope to become profitable in the future.
So a little bit buyer beware, right? Like
Correct.
really nice economic trends in terms of the price cycles that have been reasonably consistent, but your cost profile and your ability to function is changing potentially pretty dramatic. And I think most folks are aware that district by district in California is you need some expertise in order to do it right, but that's only going to increase as these implementation cycles start to come in. Well,
That's
guys,
right. And
oh, go ahead.
so that same story exists, across the spectrum, right? So there's people that have plenty of surface water, and it's just not an issue. They don't rarely talk about Sigma, and we demonstrate kind of an extreme there, where I talk through how much water they have available to pump and how that's going to constrict over the future. So in that everyone's farm is somewhere in between those two things.
Guys, this has been great. I've taken a good amount of time, and I know a good amount of our listeners' time. Sort of a quick recap here, right? When we get into the core commodities, Kyle, I think what we're hearing through the Corn Belt and the Northern Plains is, yeah, things are a little tighter, things are a little more expensive, but farmers are more or less sticking with their leases. And our forecast is, hey, there was some profitability in 2025 and 2026. Still looks like there's largely going to operate green.
Yeah, I agree with that, Dave. And hearing everyone else talk, it makes me feel fortunate that I'm here in the Midwest and we're not seeing as many struggles as everybody else on the call today. And Mike, one thing I've told Dave before is when you walk into a grocery store, everything that's in there here in Central Iowa seems to be overpriced at this point. Not by a little, but a lot. But the only thing I feel like that is underpriced is apples, and so which is unfortunate for you, and I feel like the quality is incredible as well. And so when you say the quality has gone down a little bit, I'm not seeing it here in the Midwest, but I do feel like apples are the only value you can buy in a store. So
Kyle's trying to single-handedly cover some of that gap between the current market
I eat
and
a
the
lot of
production.
apples, so
George, I think what I heard from you is that there is going to be a significant, and you're actually seeing it directly, a number of guys pulling back. And that's probably at least half, if not more than half, not from financial distress, but just that's where they're at in their career and they don't want to take on the challenges. Landowners are likely to come out in 2026 in reasonably good shape, but it's going to rely on these subsidies coming through.
Yeah, the subsidies are definitely going to help. Also, I can, like for my portfolio of land I manage, you only have two landowners that have any debt, and it's very low, low. So if you're going into looking at financing new assets, yeah, the numbers completely get different. And then, I didn't speak to this, but one thing that's a little bit concerning to us on the rice side is just the supply demand. We haven't had a barge of rice leave Arkansas, through the Arkansas River, Mississippi River this year, loaded with rice leaving the country. And we're still probably sitting on 35 million acres of 35 million bushels of last year's rice. We only raised 3% of the world's rice. So that's really got this imbalance. But on the positive side, with the subsidies, that gives us a chance to maybe look at restructuring some leases a little bit better to get away from rice, reduce that supply, and maybe kick demand up. So I'm still very positive for the coming year, and I think like a lot of guys, you're starting to really look at your cost structure, your overhead, your operation, and really right size, make sure everything is going good. And when we come out of this, it'll just be that much better, right? Going into the future over the next 12 to 18 months.
Yeah, so I agree. That's good feedback. So, Adam, in your world, there's a lot of stuff that's just operating right on that borderline, and there is some problems that are out there, but you're kind of still short on information at this point to really say, hey, 2026 is going to head in one direction or another when we think about contracts and some of the price dynamics as you're sitting right on the middle of that tipping point.
Yeah, agreed. And, I would just tack on that. It's making the good operators better too. I mean, they're just streamlining, becoming more efficient, so on and so forth. And I think we're going to see some consolidation in some of these sectors, or I should say continued consolidation. And there's definitely from a transaction standpoint, it's a buyer's market out here right now, and there's a lot of opportunity for the guys that have been successful to continue to be successful and grow their operation, and definitely still have a ton of investor interest in the asset class out here in the PNW. So,
And Mike and Brian, we just sort of got through the conversation with you guys, so pretty fresh in mind. Mike, you got a supply problem. Brian, you got a water problem, and we'll see how they sort out just a little bit. I do really appreciate you guys taking the time to help inform us on what's going on, and I think broadly speaking, we maybe don't have as many issues out there as what some of the popular press is saying, but certainly willing to talk to folks that want to learn a little bit more and let any of us know if you've got any questions. So thank you guys very much.
Thanks, Dave.
Thank you.